Doug says this may be a stupid question, but why do you even bother scaling out? For example, let's say you're in an open position with 3 contracts. Why scale out one for 10 ticks of profit, another for 30 ticks of profit, then the last for 80 ticks of profit? With journaling, shouldn't you be able to tell if you're exiting too early and start to transition towards holding all 3 contracts for the full 80 ticks? Especially considering if you enter with 3 contracts and the trade goes against you immediately and keeps going, you take a full loss on the 3 contracts. I mean, it's a valid point. It comes down to a couple variables, Doug. One is how often, and quite frankly, I don't know these numbers for me, but I will tell you after I talk about the real math of all this, I'll tell you the ultimate reason, which is a non-maximized positive expectancy answer. Okay, so let's go back now. The math to figure out what is ideal there is to take a look at the times at what's the percent of times where you get a full stop out with no scales given. How often does first scale and then stop happen? How often does first sell, second scale and stop happen? And how often does all 3 targets, let's call them, get achieved? What's the percent breakdown of each of those? And then what's the general, right? It's very hard for me to, I don't have fixed targets. They're always dynamic based on market generated information. What's the risk reward of each of those, right? So now you're looking at the expectancy of each of those situations because I know the win percent of each and I know the risk reward of each. Quite frankly, I've studied that in the past with my trading. And what I can tell you is that I'm a fairly low-ish win percent trader, right? I bat below 50% almost always. There's times where I get on a streak and I'll be 70%, but that's very rare. As you guys see, most of my trades have been losses of the past 2 days, and I'm profitable in every single product I've traded every single day, right? And my win percent is, I glanced at it, I think it's 39% for the week here. Where was I? So there's the math. If you want to figure it out and you want to just maximize expectancy, I'll tell you why I scale out. Number one, I do have a lot of scratches and stops. So scaling improves my profitability in that regard because I am wrong a lot in terms of my ultimate timing on the full kind of narrative idea. But as I mentioned, the non-mathematical answer and the one that matters the most is drawdowns, my equity curve. I know that I smooth out my equity curve by scaling out. I may not make as much this year, maybe. Okay. I might not make as much this year because I scale out. Maybe. It's debatable. I don't know. But I don't care because I prevent so many full 1R losses. I prevent so many because I get partial scales, I reduce risk, I book a little bit of profit, and that makes my month to month much more smooth. Right? So it's a little bit of practical type stuff there.